Good morning and welcome to our joint webinar with Clydesdale Bank and Clarkslegal on employee ownership trusts, also referred to as EOTs for short. My name is Ian Barton. I'm the Managing Director in Quantuma's corporate finance business, and I'll be the chair for the discussion today. In this webinar, we're going to provide you with a brief overview of EOTs as a viable mechanism to sell a business. We'll discuss the benefits, the disadvantages, and the ways to structure an EOT, as well as the reasons for why you would use a bank to help fund that EOT transaction. The Q&A function is open on this webinar, so do please feel free to submit your own questions in real time. Our webinar on this topic last year, we were absolutely overwhelmed with questions, so we in the panel look forward to seeing what areas you want to get deeper into today. And we've also had a few questions already submitted beforehand, so we'll do our best to answer as many of those in our hour as we can. Before we kick off, just ask for your patience if we do experience any connectivity difficulties. But with that, let me introduce you to the speakers for today. First up, we have my colleague Adrian Howells, who is a director in our corporate finance team. Adrian is a corporate finance specialist working with small and medium-sized enterprises to help shareholders achieve their goals. He's got significant experience in selling businesses to maximize shareholder value, buying businesses to assist shareholders in their growth and acquisition strategy or as part of a management buy-in, providing debt advice, whether that's to facilitate a transaction or business growth, capital spend, or enabling shareholders to take some money off the table, and financial modelling. Following on from Adrian, we have Stuart Mullins, a partner at Clarkslegal, who is a specialist tech startup advisor for Forbury Tech. Stuart has got extensive experience providing effective corporate and business law advice to a wide range of businesses across all sectors, particularly on corporate structures, insolvency, and business funding. Finally, we have John Palmer, a director in the Clydesdale and Yorkshire Bank's cash flow finance team, where he supports small to medium-sized enterprises from a variety of sectors as they seek to raise debt for management buyouts, acquisitions, and growth capital. More recently, John and the cash flow team have been working closely with specialists in the market to create a specific offering to businesses raising debt as part of a sale to an EOT, and as a result have completed a number of transactions in the last 18 months. So with the introductions made, I'll hand over to Adrian to start the discussion. Adrian.
Thank you, Ian. Good morning, everyone. Thanks for joining us. I've got a reasonable amount to cover, so this might be slightly whistle-stop. If anything's a bit too brief, do feel free to get in touch with any of the panelists, either in the Q&A or our contact details will be at the end, so more than happy to cover this in more detail with you afterwards. First of all, what is an EOT, an Employee Ownership Trust? So introduced as part of the Finance Act in 2014, this was quite a progressive piece of government legislation, creating an alternative method to sell a business to the more traditional methods that we're all familiar with. By traditional methods, I'm referring to sale to a trade buyer, a competitor, or a sort of management buyout type structure, often backed by private equity. With an employee ownership trust, rather than selling to a third-party buyer, you are actually selling, in essence, to your staff. So you sell to a trust which holds the business on behalf of your staff. So your staff become de facto owners of the business. It has various tax advantages, which I will come onto, and as a result of that, it's been sort of back on the agenda more recently, as there's been a lot of talk about what might happen with capital gains tax in particular. So hopefully that covers what an EOT is. What I want to focus on is three key things. So the advantages of using an EOT, the disadvantages of using an EOT, and then finally just a quick run through what a transaction process would look like. So if I can get my first slide, please. So I'm going to come about this sort of almost from the other way around, i.e. what are the problems in a traditional exit, those that we're more familiar with, and those of you particularly, many of the lawyers will be on this call, will be all too familiar with some of the pitfalls of a traditional exit. So, first of all, we've got to find a buyer. That is not an easy process. That is a drawn out, quite lengthy process. With the best will in the world, you will never find, particularly if you're going to trade, you will never find the optimal or the full list of potential buyers. You end up in sort of endless meetings with potential acquirers as well. It's quite time consuming and can be quite draining, frankly. You then move on to price. You don't tend to set a selling price. You might set an expectation. You don't tend to set a selling price when selling a business. So you end up going into price negotiations, which inevitably become price renegotiations. And we're probably all a bit too familiar with the last minute price chip. You are then managing multiple parties. So there's various sets of lawyers. You have the buyer's lawyers, the seller's lawyers, the bank's lawyers. There'll be various diligence streams as well. So financial due diligence, commercial due diligence, management due diligence, legal due diligence. And finally, of course, we're going to probably have some sort of tax advice coming in as well. All of these parties need corralling in order to ensure that the transaction remains smooth on sort of timeline and that it actually happens. You can end up with quite comprehensive warranties, and this is quite a lengthy part of processes as well, as these are sort of thrashed out between the buyer and the seller. It's quite a stressful part of the process. Although warranties are fairly rarely enacted, it nevertheless leaves sort of this risk hanging over the vendors' heads, even after the transaction. And then finally, there's a quite a chunky tax bill to pay, and here I'm talking about capital gains tax in principle. Entrepreneurs relief was reduced from a £10 million lifetime allowance down to £1 million 12 months ago. So first £1 million at 10%, everything else at 20%. Obviously, lots of conversations about that changing. We all thought it was going to change in the spring budget. It didn't, but I don't think the threat has gone away. So those are sort of, if you will, the disadvantages of a traditional exit. And so the advantages then for an EOT is that nearly all of that falls away. You don't have a protracted, lengthy buyer search. You know who your buyers are. They are your staff. You can, within limits, set your selling price. It needs to be an independent valuation and needs to be agreed by HMRC, but what you're not doing is getting into protracted and repeat pricing negotiations with a buyer. The number of parties involved are significantly reduced. Yes, there will be a number of legal parties, but much of the diligence falls away. It's much more collaborative rather than combative, and therefore can lead to a much smoother process. Warranties really only cover sort of the fundamentals, share ownership, things like that. They are substantially reduced, and so again, that stress of the transaction process goes away, and also the element of risk on the sellers post-transaction is that bit reduced. A great advantage, certainly in terms of getting the transaction done, is that the buyers do not require funding. So, we're saying we're selling the business to your staff. Can your staff afford to buy the business? Might be the question you'd ask, would ask, but actually they don't have to put their hand in their pocket at all. And then finally, and this is a particularly appealing advantage to many, EOT sales are completely tax-free. Quite a significant advantage. I'll look at the disadvantages now. Thank you. I've just noted that the buyers don't have to put their hand in their pocket. From the seller, therefore, that does create a bit of a disadvantage in that on day one, the amount of value that you can extract is reduced. Generally, the value that you'll be able to take out is the free cash on the balance sheet, and then you are looking at the business paying you out over a number of years as it earns profit. Now, we're delighted to be joined by John, who'll be speaking later, from Clydesdale Virgin Money. They are looking to help fund these transactions and put debt in at the day one point. which means that more value can be extracted by the sellers, albeit you'll still be behind where you might be on a trade sale. However, the quid pro quo on that is that you therefore leave the value in as loan notes and can charge interest on those, easily 10%, and you can get, sometimes a 5% warrant. And I challenge you to find 10% interest paid by a bank at the moment. Second disadvantage, so exiting employee ownership trusts is a less trodden pathway. This is less of a problem if you sell 100% of your shares into the trust. You aren't required to do so. You can maintain a minority stake. However, exits have been done. They are possible. They just need to be done sort of if it's in the interest of all the beneficiaries of the trust. And of course, actually, they haven't paid for any of this. So selling and getting a windfall may well be in their interest. So, that's not too much of a challenge. Those same staff will suffer an income tax event because they haven't paid up front. When the value is realised of their shares, that is sort of deemed as income tax. But again, they haven't paid anything up front. So, I don't think you'll see too much resistance as they're sort of, essentially gifted this value. Where you're generally having to step away, you do have to lose control of your business. That is a defining point of an EOT. So, of course, if you've left a lot of value behind in these loan notes, you need to, the business needs to be able to perform to pay you out. How do you keep control? Well, actually, you can remain involved. You can keep up to 49% of the shares of the vendor. You can stay on the board of directors. You can stay employed. And if you choose this sort of the corporate representative on the board of trustees carefully, which is part of the legal machinations you'll go through, that they can help look after your interests. Finally, clearly the business will be burdened by a fair bit of debt, particularly if you take bank debt as well. But this is all essentially debt paying you out. But of course, it's stress on the business. The answer to that really is to try and make sure you're carefully structured in terms of the transaction. You're not over levered. And a key thing, something I haven't mentioned yet, is that studies have shown that businesses owned by their employees tend to be more robust. They tend to sort of weather storms better, and it's because the staff all corral together around a problem because they've a vested interest in it. Okay, I'm going to look at a transaction process now, please. So this first bit sort of covers all transactions. Final bit, sale process, is very EOT specific. So the first thing is getting ourselves ready for sale. And I'll always say to anyone thinking of selling their business that the sooner you start engaging and having conversations with advisors, the better. Genuinely, 2 years out is a great time to start looking at this, because there'll be sort of strategic decisions that you may want to make that help prepare the business for sale. Once you've gone through that process and we're now ready for sale, and also during that process, you will make a decision on what sort of exit am I going to go for. Am I going to try and sell to trade? Am I going to go down a management buyout, private equity backed route, or do I want to go down the employee ownership trust route? With all of these, again, the advice would be to speak to your advisors. If you go down the EOT route, we would also advise conversations with your staff relatively early on, because this suddenly being gifted their share of the business is a bit of a bolt out of the blue. And I think the better you manage that message, the smoother the transition is likely to be. So we move into the sale process. As I say, this is only for EOTs. First of all, is that valuation is absolutely critical. The employees who are taking it over will not make an offer. We need to define what the sale price is, and we do that using independent experts. Something we can do for you. That needs approval from HMRC, so we need tax clearance from this, and again, we will deal with that for you. Once that is agreed, you can then move on and start the transaction itself. And earnings, we'll look at the funding. How are we going to structure this? Are we going to use external funding to get more money out on day one? It's quite an efficient way of getting more value out, and it's quite cost effective as well. We need to work out the structure thereon. Again, something we can help you with. And finally, to make it sound almost too simple, you move on to the SPA. It's a simpler process getting through the SPA than it is in a more traditional transaction, where there's sort of that sort of combative nature. Signing of the SPA, and you're done. Almost couldn't be simpler. I'm going to pass on to Stuart Mullins now, who's going to look at some of the legal aspects of EOTs.
Thank you very much, Adrian. Morning, everybody, and thank you very much for joining us today. I want to cover really an overview of three things really. The legal structure and how that differs from a traditional trade sale. Talk about some of the practicalities around trust. The key difference, I suppose, in compared to a conventional disposal or acquisition, and then just cover off towards the end with some practical considerations that aren't necessarily legal, but I think pretty important when considering this structure. So if we just move on really to my next slide, I think it's quite useful really to begin by sort of setting out some of the key protagonists in the EOT structure. You of course have your sellers, and those sellers are either founder shareholders or perhaps option holders, so conventional employee option holders can be realised under this structure, just as in a conventional trade sale. The buyer is a trust. That trust is established at the point that you prepare the documentation and you prepare the acquisition. That trust is for the benefit of the employees as a whole. Normally, that trust is controlled by a corporate trustee, and that corporate trustee is managed by a board of directors. And as I say, the benefit of that trust sits very much with the employees of the company and its various subsidiaries. And then moving on, if we look at the sort of funds flow on completion of the transaction, there is a flow of monies moving from the target, generally surplus cash, as Adrian explained earlier. On completion, that goes up through to the trust and then to the sellers. And as John will talk to us about in a little bit more detail, there can be bank funding involved, which is ordinarily secured on the target, taken out by the trustees, and used to fund some of the acquisition. And of course, the role of the trust really is to manage the shareholding for the beneficiaries. So the employees is a class of beneficiaries as a whole. Really, that's the obligation of the trust, and to ensure that the terms of the purchase agreement are adhered to, and that the consideration is paid, and that any surplus cash is distributed to the beneficiaries. And there are advantages and tax advantages to remunerate employees or the beneficiaries up to a certain amount, 3,600 a year, tax-free, for any surplus cash. The reality is that the trust probably meets 4 or 5 times a year to ensure that monies are paid and that the obligations under the SBA are adhered to, and distributions are made to the employees as and when possible. So our key parties here, of course, are sellers, and as Adrian explained, you have to sell a qualifying interest. You don't necessarily need to sell your whole shareholding. So you have potentially existing shareholders, you have the trustees, you have the board of directors of the target company, and you do need to be very careful about how at law the different characters sit in these roles to ensure that you're clear on potential conflicts of interest. If you have a corporate trustee, generally the corporate trustee is responsible as representing the interest of the majority shareholder for appointing the board of directors on the target company, for example, as we all know, and therefore having trustees who are also sitting on the board of directors of the target can give rise to conflict. And you have to think about, when you set this process up, how all the key people are going to play their part and where they're going to sit in and around this. And one of the ways in which you can avoid some of the conflict issues with regards to representation on the target and sitting on the board of a corporate trustee is this concept of employee council that you may have come across if you've done any reading on EOTs. And of course, the employee council really is a committee, if you like, of a representative group of the employees who have their rights and powers enshrined in the trust deed, and that talks about their roles, their responsibilities, and particularly sets out what role they'll play. And generally, they will be responsible for removing or agreeing positions on the board. They will have a say in the remuneration of trustees. Any disposal or of assets or indeed shares by the trustees will generally need their consent to ensure that the actions of the board of corporate trustee or the trustees are acting in the best interest. And generally, they will need to consent to any amendments to the constitutional document, the trust deed itself, going forward. So that's I think quite again a unique element that needs to be considered in the purchase or disposal of a business through a trustee structure. And as Adrian explained, it's very much a collaborative approach. The seller needs to set out with their advisors a pack of information, which involves a sale agreement, involves a good stab at the trust deed, involves access to a data room and DD due diligence that is akin to a management buyout, so not so comprehensive as if it was an arm's length third-party sale, and really be prepared to present this to the trustees, who then need to take advice and must take advice and discuss that in a more collaborative context with the seller, as opposed to a conventional trade sale. So if I could just move on to the next slide, please. I just want to take a moment to run through what I consider to be some of the key rules around these schemes. And I talk very much about the need to approach this collaboratively as opposed to a combative approach, if that's the right word, when dealing with a trade sale or disposal through conventional means. It needs to be a collaborative approach. The other area really is this concept of equality that comes through in the legislation, and what we mean by that is that you can't discriminate against different categories of employee. You can't exclude a classification of employee. It doesn't mean that everybody ranks equally in terms of their entitlement under the trust. But what you have to do is you have to set out some pretty clear criteria to demonstrate how people's entitlement under that trust is calculated. And but by that I mean, ordinarily your entitlement under the trust is generally linked to length of service, seniority within the organisation. That then leads, as I say, to clear criteria about how you're sharing the income generated by the trust, and also on a capital disposal should the trust sell its interest going forward. Adrian alluded to this in his presentation. It's absolutely imperative that the structure is one where transfer of control has taken place. We can't retain control via the back door. Any such suggestion would lead to it being a sham arrangement and challenged by HMRC. What do we mean by that? Well, what we mean is that a qualifying interest needs to be disposed of, which is generally more than 51% of the shareholding. And typically, when you're a seller, I find that there are individuals or sellers that do not necessarily want to turn their entire holding in the business into liquid cash. That can give rise to some inheritance tax planning issues going forward. It's about ensuring that they have enough cash to enjoy the rest of their lives versus generating too much that can cause them a tax bomb down the line. So that presents itself with a number of challenges because you do need to ensure that control has moved from you to the trust. So you do need to be careful about the usual mechanisms in shareholders' agreements, for example, where material shareholders may retain control over reserved matters. And you also need to have thought about how you implement any security for the deferred consideration and the usual protections that trigger on default may well inadvertently result in a dilution of the control test or a failure of the control test. So we have to think about that quite carefully in plan. We can overcome those problems. So not too difficult, but you do have to be alert to those things when preparing the structure. As I say, it's incumbent that the trust is for the benefit of all employees, so you can't favour your sales team over your back office function, for example, or vice versa. But as I say, it has to be equal in that regard, but not necessarily equal in terms of individual entitlements under the trust, which, as long as you've got clearly objective and defined criteria in the trustee as to how that will be realised, is acceptable. The role of the trustee needs careful thought. We have to think about who the trustees of the trust will be. That invariably will be a corporate trustee. And therefore, what we have to think about is the difficulties, as I alluded to earlier, about potential conflicts of interest with key protagonists in the structure, how their statutory obligations and duties could be compromised or challenged if they wear too many hats. So again, some thought needs to be regarded there. And of course, we talked about the requirement for a controlling interest to be transferred. So if I could please just move on to my final slide. And here we're just going to look at some of the practical things that I think you have to consider before you get into the legal docs. Valuation, as Adrian explained right at the beginning, this is where you start. It's very important to go and get an independent valuation, and I'll define that in a second. This isn't a desktop valuation. This is a detailed valuation that can stand up to scrutiny and challenge by HMRC. When I say independent, generally I would advise that the incumbent advisors, accountants are not involved in creating that valuation, because ultimately they will have a link to the sellers by virtue of their appointment. It's just the nature of the beast. I would strongly advise people to go and find a independent, reputable firm to carry out that valuation, because the seller needs to be certain that it is market value, because you're not allowed to sell for more than market value. And the trustees need to ensure that what they're paying for indirectly is the market value. So ordinarily the company, it's perfectly permissible for the company to pay for the valuation that's robust, dealt with by an independent firm of accountants, and that forms part of the sales pack. And of course, from the accountant's perspective, it's pretty important to ensure that you have sort of stepped away. You don't want to be involved in too much of this, because going forward, you want to avoid any potential conflicts yourselves and potential professional embarrassment if you've been involved where perhaps you shouldn't have been. Culture, there are, as Adrian's explained, some very generous tax advantages to the structure, which going forward, and given the interest that we've had in these webinars, would indicate that perhaps a lot of businesses are looking to do this for the wrong reasons, i.e. the tax benefits. You do need to ensure that you have a collegiate and consultative way in which you run and manage your business. You want to ensure that you've got a management team that can do without you, rather than an autocratic style. And it may well be that if you do look at your business and the way in which you run it, that you might need to plan about how you can create internally a culture where the business runs without you before this goes before you contemplate an EOT. The impact of a business not being able to fulfill its obligations under a purchase agreement or fail, are significant. So that's an important thing, I think, to address. And then finally, and I won't talk too much about this, is how's it going to be funded? Typically surplus cash on day one, and then there's some form of deferred consideration, normally between a 1 and 10 year period. But it is possible to borrow to accelerate that initial consideration process, which leads me nicely on to introducing you to John Palmer of Virgin Money Clydesdale Bank, who will look at that in some detail. So, John, over to you.
Yeah, no, thanks, Stuart. So sort of building on what the guys have already discussed, we're going to cover sort of looking at the benefits of using bank debt to fund an EOT, and then sort of go into some more specifics around appetite for lending, sort of considerations that we'd have to take into consideration for an EOT, and then finally we'll go through sort of a worked financing example, just to kind of bring it all to life. So we can just move on to the next slide, please. So Clydesdale Bank, just really very quick, brief bit of background. We're the 6th biggest clearing bank in the UK. We merged with Virgin Money a couple of years ago, and actually we're rebranding to Virgin Money, so the Clydesdale and Yorkshire brands will disappear soon. The team that I work in is cash flow finance, and we have a sort of national proposition supporting SMEs in sort of growth plans and also exit transitions. So the EOT concept fits quite nicely into our space, and to date we've managed to complete 5 funding rounds for EOTs under sort of a new specialist lending product that we've developed. So if we can just go on to why would we use a bank to fund an EOT? So I think as sort of Adrian alluded to in his piece, you haven't got any new money coming in from an incoming management team or trade buyer, etc. So if the vendor's looking to sort of extract any cash day one, aside from any sort of excess cash on balance sheet, really, a bank is or a funder is the way forward. But the way that we look at it really is an evolution of the traditional management buyout model, whereas instead of sort of supporting a management team per se, you're sort of supporting all of the employees and the business as a whole. The main advantage is the debt for the vendors is the debt can unlock equity value that would otherwise be tied up and provide cash to them without having to pledge any personal security. And that's the Clydesdale specific thing. Other lenders might have different policies, but from our perspective, no personal security or personal assets pledged. It's just pure cash flow loan. And then once you have sort of bank funding in place, you can use that lender or different lenders to advance further funding in future years, which means that time frame the vendors have for exit, which might usually be sort of 7 to 10 years, can be sort of materially reduced. And I guess the advantage for the business, for the employees, for the trust is that, again, as Adrian alluded to, the vendors might charge up to 10% on their loan note interest, whereas bank debt considerably cheaper, and kind of reduce that overall interest burden on the business in the longer term. So to move on to the next slide, we'll talk about sort of general sort of appetite for lending and sort of things to consider before you sort of look to fund an EOT. So I think the first thing that's most important to note is that there is no one-size-fits-all approach. Each transaction will be looked at on its own merits. So all the bits we're about to go through are kind of general pointers, but yeah, I mean, there's no sort of tick box exercise really. And I think one of the really key areas is that when assessing an EOT lend, it's very similar to how we would assess any other lend, which is, can the business generate sustainable cash, i.e., does EBITDA flow down to operational cash flow at a sustainable level and a strong level? The normal kind of key business risks, SWOT analysis, etc. Things like loss of markets, substitution, competition, etc. And also, the overall leverage in the business. Does the EBITDA, the business, warrant that level of debt, or the sector the business in, does it warrant that type of debt? So, kind of EOT aside, any business that's looking to raise debt would be assessed on these criteria, and it's really important to note that just because it's an EOT doesn't preclude us from having to do all the normal sort of credit work that we do on any deal. So we'll look at some of the more specific areas for lending to an EOT on the next slide, please. So this has been covered a lot by Stuart, I think touched upon by Adrian as well. It's around the valuation of the business. So with an EOT, you don't have a sort of buyer and seller relationship in the traditional sense, and therefore we as a bank need to make sure that the valuation that's been attributed to that business is fair and reasonable. So we would definitely require an independent valuation to be undertaken on any EOT deal to make sure that we're not funding against an incorrect value. And sort of moving on from that, really is kind of linked is how much of that value is actually being extracted day one. So typically with an EOT, and this is not the case for all of them, but on all the ones we've looked at to date, the vendor team are actually staying in as sort of the management team driving the business forward after completion. There'll be a transition period to the second tier management team who might also be taking EMI shares, etc. But fundamentally, the vendor team are still there and they're still driving the business forward. How much of that value are they extracting on day one? Are they still incentivized to drive the business forward, or actually are they taking so much off the table that that we can't really rely on them to run the business going forward. And then kind of just touch on then, second tier management team in particular, are they suitably incentivized? Obviously the EOT, the concept of the EOT is that all employees should be suitably incentivized via, shared beneficiary of all the profits, especially when the bank debt's been repaid. But are the second tier management team, do they have separate shareholdings, equity instruments, etc., to give them incentivization? And then finally, specific to the bank, is the payment terms relating to the deferred consideration. So we would obviously want those payments to be subordinated to our debt to make sure that we're repaid first, but we would allow payment of interest or capital under certain circumstances, which we'll come on to in the specific funding requirement in a sec. But we just need to make sure that we're comfortable with those payment terms. And I guess if you're putting together an EOT and you want bank debt, something to think about is, whilst you can extract more cash day one, you might have limitations on how much you can extract whilst you have bank debt in play. So going to the next slide, we should have a worked example. Great. So this is the very imaginatively named ABC Limited, with EBITDA of £2 million valued at 5 times. So this is a £10 million business with £1 million of excess cash, i.e. cash not required for working capital on the balance sheet. So in this example, and this is purely illustrative, we've done bank debt of £3 million, which is 1.5 turns of leverage, and that repays over 5 years. And that means that cash out to the vendors would actually be £4 million on day one, which is 30% of the equity value, plus the £1 million of cash. And as Adrian alluded to, you don't pay capital gains tax on that versus the 20% you pay on a normal trade sale. And obviously that might increase in the future. We don't know what's coming down the track. So quite attractive. And then the deferred consideration of £6 million is what's left to the vendors, as we alluded to, subordinated to the bank. And in this particular example, we would use some kind of second tier cash covenant, 50% of excess cash generated, to allow that vendor loan note to be repaid, subject to an overall cap of £500,000, which is specifically done to kind of make it slightly less than the rate at which the bank debt is being repaid, so that we delever quicker. And you see, as we alluded to at the start, bank security is just a charge over the trust and debenture from the trading company. We don't take any personal security. Obviously, the value of the business is in the business, not in the trust, so we do need to take security there. And then just a charge where the debt sits, which is a trust level, just to wrap it all up. And then again, in this example, subject to trading at the time, we would want to put further debt in probably 2 to 3. I've said 3 years there, but probably actually more like 18 months to 3 years. We'd probably want to do a refinance and increase to put more debt in, which will allow further equity value to be extracted. So kind of shows you there how quickly you could actually have the vendors sort of paid off and sort of the EOT running purely for the benefit of its employees and profits being distributed thereafter. So that's me. That was very, very whistle stop, but I'll pass it back over to Ian for Q&A.
So, well, thanks very much to Adrian, Stuart and John there for talking us through sort of all the different aspects. And it's clearly a complex topic, and whilst there are lots of similarities with MBOs or M&A type transactions, clearly there are some very specific areas which are different. And as Stuart was saying, there are clear there's a clear structure that needs to be followed, and if you interfere too much with that structure and cause the EOT to fail, then the consequences are quite significant. So it's important, as was said there, to enter it with the right cultural spirit in order to gain the benefits of timing, as Adrian talked about, flow of funding, as John's talked about, and future structuring, as Stuart's talked about there. We've had a whole variety of questions, and I'm going to try and, rather than asking them specifically, I'm going to try and sort of group them a little bit. We had a number of questions around how the price is set, and I'm sort of hoping that the answers that have been given by the panelists have covered that off for most people. in the sense that it's not a negotiated position, but it has to be an independent valuation that the trustees can rely on. And that's really the key. And as John was saying, that's an important element from a funder's perspective as well. But one area that I did want to pose back to the panel was around how the shareholdings are split. And I know, Stuart, you talked a little bit about how the employee ownership trust itself might be shared out amongst the employees. And perhaps you could open up by just giving a little bit more flavour around that and how you might differentiate different employees within that trust. But also, there's been a few questions around, are there ways that you can motivate the more senior members of the team, perhaps outside of the EOT with other shares that are not in the EOT, so that you can motivate people perhaps have only just joined the business for future financial gain?
Yeah, certainly, and thank you for your questions, everybody. So the first thing is, it's entirely feasible to adopt a CSOP or EMI option scheme for the benefit of key staff through EOT ownership. So you can still have those tie-ins and motivations. As I hope I explained, that the principle is equality, in that you can't close the door on people or classes of employee. It has to be for the benefit of the whole. But the way in which people are entitled to share can be distinguished. So it doesn't have to be equal, in the sense of, how long, what's the seniority, how long have they been employed in the business typically, and as long as those criteria are objective and set out in the trust deed, it is entirely possible to deal with people unequally in terms of value to the trust, but equal in terms of it has to apply to all employees and not just a division that you might favour over another, or back office versus sales as a simple example. It has to be for the benefit of the whole. And that's what the legislation means when it talks about equality. It's not about equality in quantum. You can distinguish, as I say, between seniority and length of service, as long as that is objective criteria and not discriminatory, and it's set out in the trust. So the trust, one of the questions that came through was about, it sounds like there's a lot of administrative burden with an EOT. I disagree with that. I think it is ultimately a streamlined, speedier exit compared to a conventional MBO. I mean, that's what we're talking about. We talk about culture and people being aligned to a business. We really are. We're really talking, as a very tax efficient route to an MBO. And as I say, it sounds like you've got a supplemental document in terms of a trust deed and some other key players in the game, or the play, if you like. But it just needs to be carefully thought out and planned, and as Ian says, follow the statutory process. I don't think it's administratively more burdensome, especially when most boards of trustees will probably meet 3 or 4 times a year.
Sure. Am I right that it is possible to overlay an EMI scheme as well, so you can further differentiate? So if you've got a second,
absolutely, the tried and tested incentives through CSOPs or EMIs are still playable, still applicable, and still relevant to a business or company that's owned by predominantly by an EOT, as opposed to private individuals. That nothing changes there.
Fine. So in other words, if we've got a tier 2 management team we're trying to bring on who can sort of ultimately take over from the vendors, actually we can still sort of properly incentivize them almost beyond the rules of the EOT to a degree, using those traditional methods.
Absolutely right. And just picking up on another point that talks about, what happens if the EOT sells the business going forward? How do you protect a seller from, not sharing in that increased value? It is entirely possible in the sale agreement to build in, conventional anti-embarrassment clauses, which gives the seller the benefit of an uplift if the trust disposes within a reasonable time after you've sold to them.
Yeah, and that sort of exit area, there's a few questions around that in terms of how does that unwind effectively? And I guess there's two parts to this question really. In a positive sale, and the value then passes into the EOT. I think, Adrian, as you said, that value then passes through the employees, and okay, they have to pay income tax, but then they didn't have to pay for the shares in the first place. So, even at current rates, it's still a 55% benefit effectively for the employee. But on a more negative side, what happened? There's a few questions here about what happens if the business itself fails through that point, and I'm sure John, if he's put bank funding in at that point, will be pulling his face and starting to worry about that. But from the employee's perspective, a lot of the questions have come in say, well, what happens there? In the the trustees have then got to effectively go through a distress procedure. I don't know if the panel's got any thoughts on any of that.
Stuart, is that right? There's a bit of a risk to this area, I think we've discussed before, there's a bit of a risk to the vendors, isn't it? If an EOT goes bang quite soon, actually, and sort of fails, I think I'm right, and you'll be able to elaborate on this, but actually the tax benefit can fall away as well, so it can be a bit messy.
Yeah, I must caveat by saying I'm not a qualified tax advisor, but generally, if the worst was to happen, you end up in the advantages of the tax treatment that you would otherwise enjoy being unwound, and therefore liabilities falling due to HMRC. But this is the point that sort of made earlier about culture. I mean, it's not a legal point, but it is really important to make sure that you have your business structured in a way that it has confidence, that you're confident that it can perform its obligations, and that's ultimately one of the reasons for the fair value test that the rules require. You can't rip the heart out of the business; it's got to be a fair price, and if you get that wrong, there's an issue. And similarly, as I say, you've got to spend time. I mean, you have to think about it. I mean, everybody thinks of every business owner thinks they're the best business owner out there, but that you do have to look yourself in the mirror and be clear. Does this business do all right without me? Can this business run? Are the team qualified enough, experienced enough to run this without me? If the answer is no, then you probably need to think about internal organisation, developing people to get to a point where you can say, absolutely it can. Because if absolutely it can, and it's the right value, and you've structured the consideration in a way that involves sensible discussions with people like John, you're then in a position to safeguard the problem.
And that sort of feeds into what I was talking about in terms of prep for sale, and actually, looking to do this up to 2 years in advance to be able to put those sort of cultural bits in place. But it's probably worth noting that if the whole thing is absolutely stressed, right to the edges anyway, and therefore at risk of going pop and the whole system unwinding, and actually all of your loan notes are at risk as well. So you really do want, it's in your interests that, as Stuart has said, that the business is in a good shape. Generally, though, as I said earlier, if you're in a good shape, EOT businesses tend to weather storms better. Also, the point I think about the tax advantages unwinding, that's not an indefinite point. I think I'm also not a tax accountant, but I believe the rules are it's essentially so long as you, I think it's when you reach your first tax year and you have one additional year, and so long as the business survives for that period, if it were then to go under, you wouldn't lose your tax advantages. Clearly, though, in almost all structures, business would still owe you, as the vendor, some of your loan notes, and they would be lost, as would anything owing to the bank. So, it is important to get that correct.
And this is about the reason that this has the benefits in terms of the tax position. The cross-party team politicians. There was a paper produced on this where they said that, ironically, they called it the John Lewis model, although John Lewis isn't owned by an EOT. But the concept of having a business where everybody has albeit indirectly, has a vested interest in the performance and feels involved and empowered as part of that ownership, is hugely beneficial for society generally in terms of, the stats are that, there's less turnover, there's better engagement, and therefore the business performs financially more profitably generally. These are the stats, and this is about employee engagement principally, and therefore, you should be driving this if it's for the right reasons, not just because there's no tax on the disposal of your shares.
Yeah, I mean, conscious of time, and John, it might just be worth picking up, because there's a few questions that have come out here around comparing EOTs to MBOs in an approach, and perhaps from a bank's perspective. I know you talked through there the example on ABC, but but perhaps from your funding perspective, how you look at an EOT compared to an MBO, and whether there are any material differences in approach that you take when considering an EOT.
Yeah, absolutely. I mean, with an MBO, one of the key things that a bank will look for is what new cash equity is coming into the business. So even when you've got a non-sponsored, i.e. no private equity coming in, it's just the management team buying the business off the vendor team, we would still expect to see some money going into the business from that management team as hurt money, usually sort of broadly one-time salary, which even for a lot of management teams can be quite challenging. And with an EOT, I guess on the other hand, we don't require any new sort of cash equity to come in, so you can purely fund it 100% on between debts and vendor financing, i.e. vendor loan note. So that's probably the biggest difference between the two. But what attracts us to the EOT over an MBO is, with an MBO, one of your key risks is management change. So you've got a new management team coming in, they've got to take on those customer relationships, etc., and drive the business forward, whereas they haven't had to do that before in most circumstances. Whereas with an EOT, as I sort of alluded to, the vendor team are usually staying in sort of senior management positions and are still responsible, at least on day one, for running the business. So that entire risk around change is incredibly minimal versus an MBO. So actually, from a bank's perspective, an EOT is a preferable structure to an MBO. We would rather fund an EOT.
And I'm conscious that we're at 10:30, and so on that positive note, we'll try and wrap it up. Look, there's been a whole series of questions there. Some of them are quite specific around share splits and valuation points. And what we will do is we'll endeavour to get back to those individuals who've asked those specific questions with some observations and some thoughts as well. But as the slide shows, if there are more specific questions or things that you want to ask about your own business or an opportunity you're own thinking about, please do get in touch with any of the panel to talk about those specifically. So look, we hope you found today's joint webinar with Clarkslegal and Clydesdale Virgin Money engaging and informative. Thank you for your questions. Thank you very much to the speakers for taking time out this morning to share their knowledge, expertise and experience. And hopefully, as we move into next week, we can all get a chance to move indoors on pubs and restaurants. And no doubt that will be just the time that the weather picks up and we'll all want to sit outside. So with that, thank you very much for joining us and have a good day. Goodbye.